Good morning, everyone, and thank you for joining us on a Saturday morning for discussing our results of the quarter and the 9 months ended December 31st, 2020. Mr. Vijay Kumar, our CFO, and Mr. Qtr3, our Senior Manager Accounts, and Stellar IR Advisors, our Investor Relations Advisor, are on the call with us today. I hope you had a chance to go through the investor presentation that is uploaded on the website of the stock exchanges. Now, with the rollout of the vaccines around the world, we are seeing some sort of normalcy return to our lives, and while the worst may be behind us, there are still pockets of challenges that people continue to face around the world in lives as every part of life. During our calls in Q1 and Q2, we were operating with several challenges, including labor availability, sudden drop in demand, logistical challenges, and supply issues. While a lot of these have eased, even though they have not been completely out, but they have eased out over the past months, there are some issues that we faced in Q3, which I will elaborate in the next few minutes. Let me take you through our operating performance in the quarter gone by. On the demand side, as you are aware, our product mix has been retail-focused, and while demand from the institutional side, the food service sectors, that is the restaurant and catering business, has been subdued, catering demand and in-home consumption continues to be steady. USA and Europe had seen targeted lockdowns again in phase 2s, but we are hopeful with the rollout of vaccines and as the number of cases of the COVID-19 come down, we should see a bounce back soon as things are changing. With regard to China, one of the first countries to have the least amount of effect of COVID-19, they have been importing quite a significant amount of products in the beginning, but during the middle of the year, they started finding traces of COVID-19 on packages of imported food products, whether it is from Ecuador or from other countries of the world, including some from Russia. So China has been very cautious in allowing imports into its country, into the country, and also there has been a significant effect on the seafood imports also, including fish and shrimp. So there has been significant delays even in the clearance of the shipments which have gone to China, and also thereby affecting the realization of those such business. However, in our company's case, we didn't have any exports to China in the third quarter. With regard to European Union, we did have a good set of business, steady business. However, post second phase lockdown in France and United Kingdom, the consumption has been challenged, and overall the demand has been slowly recovering as things get better as they come out, those markets come out of the pandemic situation. USA, main market for our country, for our company, as well as for the country, India, which is the largest consumer of shrimp in the world. Restaurants have been closed significantly until a month and a half ago. Slowly, things started improving. They have opened up for indoor dining, and however, the number of guests permitted in these restaurants, which is and the food service segments, where the major consumption of food, which is protein primarily in those markets, and also shrimp. These restaurants have been working at under capacity. It's around 25% of their capacity. So slowly the demand has been picking up. But main area of focus this year, for sure, because of the way the lifestyle changes, the way the pandemic has changed the way of the norm of life, the main focus is on the retail segment, and the retail has been fairly going well. However, the retail segment is not entirely able to substitute the loss of business on the food service sector. So it has been reasonably well, and the retail segment is also all the retail outlets and our retail customers are also looking forward to place the orders for the next the current calendar year, that is 2021. However, there has been a major issue even for our retail customers because the present orders which they placed prior to the holidays, that is Christmas and New Year, and as well as which were meant for the consumption during that time, have not been reaching them in time, primarily because of the logistical challenges which have been across the globe, which I will elaborate a little later. On the supply side, we had indicated that there was a change in the cropping cycle. We are happy to note that the cycle seems to be stabilizing, and the stocking has been encouraging for the calendar year 2021 so far, and we are hopeful of a good produce. And of course, it is subject to weather conditions and any disease outbreak. But as of current day, we understand except some sporadic disease issues in some areas, but most of the farms where the stocking is happening, so far it is stable. So we look forward for a good output subject to any other weather conditions and other factors. We hope that we will be able to get a good output from most of the farming areas starting in the months of March and April of the current calendar year. The farm gate prices have been very stable, more because of the demand and less supply, the demand from many of the exporting companies within the country. However, the supply was not available that well because of the various issues over the past 4 months. The other important point, which I have mentioned earlier, has been logistics issues that have plagued us, that we had highlighted in the previous quarter also. This was happening since the month of middle of August, and that we are hoping this would get sorted out eventually. However, things have taken a turn for the worse with a severe shortage of containers or equipment, which basically enable us to do our sales in the volumes which we do to overseas countries, overseas markets. And this equipment shortage has been there globally, and it has hampered our ability to deliver or ship our finished products. This logistics challenges has primarily begun with China absorbing most number of containers from across the globe for the past 4 months, and it's still continuing because China is not able to, it's restricting its imports currently, and most of the vessels are still docked outside several Chinese ports because of their suspicion and the extra concern they have towards any spread of COVID-19 through the imported produce or imported packaging of various products. And then on the same lines, several U.S. ports are having vessels standing outside the ports, primarily, especially on the west coast, where the vessels are not being allowed into the ports, thereby hampering the return of such equipment, which is all bound for the United States, because usually any equipment which goes into a country and subsequently returned back is useful for other purposes, for export and import into various markets across the globe. So several equipment issues are there between the markets of USA, Europe and China, and currently we are facing a severe shortage in India, where we are being currently given on ration, and also an increase of freight costs because of the demand which is there, and also the transshipment time. The sailing time has also been increased, just typically 30 to 45 days on an average to the United States is currently going at 40 to 60 days. Extended times of sailing have an indirect effect on the working capital issues. Working capital cycles also get stretched. So because most of the realizations of our company are based on receipt of goods overseas. So in the quarter gone by, this issue has led to a drop in sales because the shipments could not be moved. This had a cascading effect with an increase in our inventories of finished products, and as I mentioned, a stretched working capital cycle and a lower absorption of the fixed costs of our newly commissioned plant that added a significant in-house capacity. As a result, we saw our revenue shrink and our costs expand, and consequently, our profitability for the quarter was impacted. Further, as you are aware, the MEIS scheme, which was capped at a small amount in Q3, and has been discontinued from Jan 1st, 2020. While a new scheme has been announced to replace the MEIS, we are still awaiting the details from the Government of India with regard to the percentages of the benefit which they would allocate to our sector. As of now, it has not yet been formalized, even though the scheme is available from Jan 1st, 2021. Sorry, I just correct that. So we are waiting for Government of India's clarity on that part. So one of the major reasons also in the fall of profitability is also attributed to the discontinuation of MEIS for the entire third quarter. However, this is an aberration, and on the bright side, the value-added ready-to-eat segment is being well received by customers, and production of this continues to be our focus. While overall volume shrank because of the reasons stated above, the share of ready-to-eat increased to almost 22% in the Q3 of the current financial year. As a result, and as anticipated, our per unit dollar realization has improved both year-on-year as well as quarter-on-quarter. The ready-to-eat products, which are primarily cooked products, have been doing well with the retail customers. In fact, a significant amount of production which was done during the Q3 could not be shipped out because of the main challenge of logistical issues, the equipment support from the shipping lines, which otherwise would have definitely maintained the sales nearer to the Q2 of the current financial year. Unfortunately, this was something beyond the control of the company or the sector as such. The whole country has been affected because of, and the whole globe, the whole world has been affected because of these logistics issues. Now, in the case of ready-to-eat, we also would like to inform you on this call that we have also had a great success with a new kind of product which we have been doing for the past 18 months, which is basically, we could call it ready to prepare, where the product is very much seasoned and prepared well for in advance so that people can just utilize the product, they can just cook it or basically put it on a skillet and just it's easy to consume. They don't need to prepare. So it's actually already prepared. So it's ready to cook pretty much, but it is all seasoning, whatever is required is already done. And we have been having a good success with that. We are hopeful that we'll be able to do much more of that product during the next financial year as we utilize our production capacities. Lastly, a quick update on the progress of our other efforts. On the hatcheries, as stated during our last call, we have discontinued the lease facility and the construction of the phase 2 of the hatchery at Ongole is nearing completion. We are hopeful that this will come online by the end of this fiscal. With this, all our hatcheries are owned and operated by the company. With regard to farming of the company, we have been consolidating the extent of area which we are currently operating. In this year, there has been a significant consolidation taking place as we want to focus more on the core activity of processing and export, which I have elaborated over the last 2 quarters. And this will be assisted by some of the hatchery business, which is primarily meant for developing our relationships with the primary producers, farmers, and make it much stronger by giving them quality seed and able to do the buyback of the raw materials from them. With that, now I request Mr. Vijay Kumar, our CFO, to take you through the brief highlights of our financial performance. Vijay Kumar.
Yeah, hi. I shall brief you on the financial highlights of the quarter and 9 months gone by. As mentioned earlier, our product mix has been improving with a higher proportion of retail and value-added products, which have aided the overall realizations up by almost 12% year-on-year and 2% quarter-on-quarter. For the quarter ended December 31st, 2020, our export sales revenue was rupees 1,500 million versus rupees 1,754 million in Q3 FY20, a decline of almost 14% year-on-year. The fall in revenue was as a result of reduced volumes, which stood at 2,178 metric tons versus 2,842 metric tons in Q3 FY20, a decline of almost 23% year-on-year. The geographical breakup is as follows. 85.4% came from US, while the balance 14.6% from European Union. As on 9 months of FY21, the net revenue. For 9 months FY21, the drop in export sales revenue was only 4% year-on-year to rupees 5,973 million, despite volume degrowth of 11% year-on-year to 9046 metric tons. Profitability in the quarter also took a hit as a result of lower revenue as well higher fixed costs stemming from the lower utilization of our newly expanded capacity due to the reasons stated earlier by Mr. Chaudhary. Our EBITDA stood at rupees 190 million versus rupees 286 million in Q3 FY20. For the 9 months of FY 2021, our EBITDA of rupees 772 million translated into a margin of 12%, which was largely stable year-on-year. Higher depreciation due to the new plant coupled with increased finance cost and even higher inventory resulted in a decline at PAT level, with our PAT for Q3 FY21 coming in at rupees 23 million versus rupees 212 million in Q3 FY20. For 9 months of FY21, our PAT was rupees 359 million as against rupees 515 million in the previous year. This is all from our side, and now I request the moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Awasthi from East India Securities. Please go ahead.
Hello, sir. Thank you for the opportunity. Wanted to understand a few things. Firstly, on the industry. Secondly, we'll come to the bookkeeping part. Like you mentioned, even our ground check suggests that diseases are ramping this year around. So ESP is back, and it's back in a big way, and it's spreading more than normal. And are any of our farms getting affected, sir, or areas around our farms getting affected by the disease?
Mr. Nitin, as I had mentioned, irrelevant of the current any disease-related issues, the farming operations of the company have been consolidated, and it's in the process of almost exiting out of the farming operations, which I have explained over the past 2 quarters. But in general, as I always mention, disease is going to be there. It will always be there. It's just that how it is managed by different farmers, different producers is one part. And it will be in different areas. It's not like one area, if there is a disease, it's not that another area is going to get affected. It also depends on the way they do the stocking of seed in their farms. If they do higher stocking densities, naturally the risk of disease spread could be higher. And if there is too much of density of farms in one particular area, the risk of disease spread could be higher. So there are factors related to the way these farms are positioned in different areas. But with regard to companies' farms, as I had elaborated just a few minutes ago, that we have actually been consolidating our farming area. Except for one location which is completely owned by the company for the past 5 years, almost 7 years, sorry, which is in total isolation, which doesn't have any other farms around it. That is the company-owned land, but all other farms we are basically exiting out, and currently we are in the process of consolidating the fixed assets, and we are going to basically dispose them off. As I mentioned, we are exiting out of the farming operations in totality. Except whatever we would do, it will be only in our own land if it is there. But otherwise, the disease spread is there based on various factors. As I said, it depends on the extent of farms which are there in each geographic area, and also the density of shrimp or the shrimp seed which they stock in their farms. There are certain areas where the disease is not present because that area, there are few farmers or whoever are there, they would be stocking at a very low density.
Got it, sir. So on the farming operation front, what is our current land holding? When I say land holding, I don't mean owned by the company, I mean total farming area, and what number will it reduce to?
The current farming area would only be to the company-owned farm of 120 acres. Apart from that, pretty much all the other farming area has been closed, or basically the fresh renewals of lease agreements have not been done, and most of these agreements, as they have been coming to an end, we have been stopping in phases. This has been happening since the beginning of the year. It's not a sudden event of Q3 or Q2. It's been happening since almost during the end of last financial year. That is the thing, and except the company's own land of 120 acres, the rest of it is pretty much true. That's the only thing, that's the only farm area which will be remaining with the company by the end of this financial year.
Got it, sir. So is the employee expense drop related to the farming area, employees being let go, or is it because of the insurance premium payment being lower this quarter around?
Sorry, can you repeat your question, James? I'm sorry.
So this quarter around, the employee expenses have come down. So I was wondering why that is. So is that because farming expenses or farming employees have been let go, or is it because the insurance premium, which was higher in the previous quarter, is lower this quarter around?
No, this has less to do with farming employees, because the farming employees are not anywhere near to the number of employees which the company recruits for its processing operations. The farming employees, of course, have been repositioned as required, and some of them have been let go. But the main reason why the employee expenses has also been down, as the company had to decide of capping its production beyond certain level. Already you can notice that the raw material purchases did not reduce significantly for the revenue which has been reduced in the quarter which we are talking about. Naturally, when there was a stage where the company had to decide of keeping the production level at lower level, at a reduced level, with the compelling reason of none of the finished product having the ability to get shipped out because of the logistical issues. So it didn't make any sense for the company to try and achieve its maximum output, or trying to utilize its existing capacity, including the greenfield project, to at least to an optimum level, or to whatever was to the extent of 50% and beyond, which was planned current year, because it didn't make any sense, because none of the product was getting shipped. So of course some of the employees were being kind of taken on an alternate days basis, and that's how it was done. Especially primarily this has got to do with the daily labor whom the company recruits primarily for pre-processing operations, which has the most number of employees, both permanent as well as daily basis employees who are there for the company.
Understood, sir. And lastly, sir, on the logistics front, if you could you highlighted the problems with the logistics cost, with the logistic cost being higher and everything. If you could just quantify how much is it higher by, and what is the actual amount this quarter and previous quarter last year?
The logistics cost for last year, I have the last quarter, which is around 9.68 crores. Hello?
Mm-hmm. Yes, sir.
That was 9.68 crores for last quarter, 30th September. And the current quarter was 7 crores 16 lakhs. If you, the rate of the freight rates have increased, and they have been increasing. Actually, even now in the current quarter which we are speaking, in the last quarter also, starting in January, the rates have been further increasing because there's a shortage and there's a demand. So normally, I'll give you a rough example. Don't take it literally, but an equipment which you would get for $3,500 to $4,000 is currently at $5,500 to $6,000. So there's been a hike of almost, we can say, 60%, 50 to 60% on the freight cost alone. And now we are also focused on bringing containers from Chennai or longer distances than where we don't even, venture out into, because we would always prefer our closest ports of Vizag, Visakhapatnam or Kakinada. And now we are going to further seaports so that we can get equipment from there and ship it out. So overall, this does increase our logistics costs, whether it is transportation or the freight costs inclusive.
Got it, sir. Understood. Thank you for patiently explaining all the queries I had, and best of luck for the upcoming quarters, sir.
Yeah.
Thank you. Any Anyone who would like to ask a question, you may press star and 1. The next question from the line of Yogansh Jeswani from Mittal Analytics. Please go ahead.
Hi, sir. Thanks for the opportunity. Can you also comment on the overall production that you anticipate the industry had during these 9 months period, and by how much are we lagging behind compared to the previous 9 months, sir? That's my first question.
I'm sorry. Can you repeat the question? I'm sorry.
Yeah. So my question is regarding the shrimp production for the overall industry level. We understand that there might be a dip in the overall shrimp production. So can you help us understand about how much are we lagging behind compared to the previous year in terms of volume?
Yeah, actually, this is a rough estimate. Of course, as you know, the production is not from one source, and it's not even recorded on a straight manner. So as a current financial year, there is an approximate drop expected of around 1.5 lakh to 2 lakh metric tons from its 8 lakh metric tons. Though it is going to be roughly, they expect around 6 to 6.5 lakh metric tons before the end of the financial year. It's a drop of almost 1.5 to 2 lakhs metric tons. That's what is the estimate by various industry players in the country from India. This, of course, primarily has got to do with how COVID has affected logistics in the beginning of the year, and subsequently disease issues and seed supply issues, multiple factors.
Right. That's helpful, sir. Secondly, sir, you spoke about the MEIS scheme. So can you also share more details as to what was the total export incentive for the previous 9 months compared to what we have booked so far?
The previous 9 months export, sorry, you mean to say for the 9 months of
9 months FY20 versus 9 months FY21, what has been the export incentive that we have booked?
The previous 9 months export sales was around 597 crores 25 lakhs.
Hello. We just want the net incentive.
Internet? Hello?
Yeah, net export benefits for 9 months FY20.
9 months net export benefits are around 19 crores 84 lakhs.
That is the current financial year.
9 months ended.
What was
he wants 9 months of 31st December 2019, right?
I'm sorry to interrupt. This is the operator. May I request Mr. Vijay Kumar to come on the handset mode, sir? There's a kind of disturbance from your line. Your audio is not very clear.
Okay, just a minute.
Thank you.
It's okay now? Hello.
Thank you, sir. This is better. You may go ahead.
Yeah, I think we'll get back to you on that 9 months FY20's information in a bit. Give us a few minutes. But FY21, 9 months ended 31st December, as you mentioned, it was 19.84 crores net export benefits in the current financial year for the 9 months.
Yeah. Right. So, just another part of that question was, now that MEIS scheme is going out and you said a new scheme is into the place, what are your expectations for this scheme? Are we hoping for a similar kind of rate, or do we expect any reduction in the rate? I mean, overall, do we see export incentive going down?
Well, the point is, as you can see, Government of India is working on these benefits, and even if you note carefully, the notifications have been changing based on, of course, their assessment, and as their assessments keep changing. Even the way the MEIS was capped at 2 crores for the Q3, which was announced in the month of August, on August 1st, saying that for the Q3 it will be ending up to September. It will be basically from September onwards it will only be at the max of 2 crores. So for the remaining quarter there was no incentive with regard to MEIS part. Of course, there is duty drawback. That's a small part. Whereas the new scheme which is there, which is primarily based on refund of duties, taxes, and other indirect tax levies which are there, it has been worked out as per what our understanding is by committee, Mr. G.K. Pillai's committee, and they have presented all the percentages for different sectors which they believe will do the right justice. However, we should see the government has not yet announced, neither we are aware of what that committee has recommended, nor what the government is finally going to decide on this. So we are actually awaiting eagerly. And if your question is, do I think or does our company think that it can reduce or will it maintain? To tell you the truth, we are hoping that it maintains, but if it reduces, it reduces, which we can't. It's all as it is a support extended by Government of India for export sectors. So the entire decision is in their hands. So we should await. Hopefully they'll give the clarity very soon, because the scheme is already implemented since Jan 1st, 2021. So whatever they're going to announce is effective retrospectively from Jan 1st, 2021. So we should just see how as the clarity comes from Government of India.
Right, sir. So lastly, sir, another question is that...
I'm sorry on that. I just need to answer that question of 9 month FY20. It was 44.8 crores.
44.8.
Yes, the net export benefits was 44.8 crores for 9 months FY20.
Got it, sir. So lastly, my question is around the various input costs that are going up in the industry, like I think the feed, the fish feed and soya meal, all those costs are going up, and that's putting a pressure both on the farmers and the processors. So how are things shaping up, sir? Because given the feed prices going up, there's not a lot of benefit left for the farmers. So what is the industry situation like? How are we, coping up with such situations? And going forward, what is your sense of the things? Do you see input costs normalizing, or do you see farm gate prices going up because of this? Because, I mean, the situation is very tricky, right? In terms of the demand side, we are seeing so many issues, and now input cost is putting up further pressure. So how are you seeing the overall situation shaping up, sir?
Yeah, I just need to tell you firstly, your question was related to two segments of the sector, which is the feed and the supply side, supply of raw material and shrimp for us, for our company. The feed part, I don't think we are the right people to talk about it, the inputs of the feed. I am pretty sure you will get responses on a different investor call. But with regard to farm gate prices, with farmers, with their costs are one part. Costs have been increasing based on various factors. But the main point in India, which is to be the core focus, is about productivity. The better the productivity is, the better the output is, the cost will automatically get justified. So how various farmers at various geographical locations spread over the country plan and strategize their farming operations will eventually decide of how their costing is going to be. And with regard to farm gate prices, even if it is for a short, brief period, whether it is 1 month or 2 months, even if the farm gate prices have no connection to what is happening globally, but they are all temporary. Eventually, it is the global market prices, whether it is USA, Europe, China, the average of global market prices, supported by the currency, supported by any incentives which are going to be going to be given by the Government of India, will all be the factor which would weigh on what the raw material price or the farm gate price is going to be. So at certain times, yes, it could be higher, but it could be lower. But eventually, it will all be moving in tandem with the realization what processing or an export company has. So it is going to be more based on how the overseas demand is going to be and how the prices are going to be, in which direction they move. But farm gate prices, that's how it will be. But farm costs, as I said, please discuss about that point on a different phone call, a different con call, where we are not the ones who can comment on the fish meal prices or other inputs related to shrimp feed. The farm gate prices, of course, as I said, one is getting the prices based on the market, but the most important point is also about productivity. The costing of the farm level would eventually be at a lower level, so that even if the market conditions correct and there is a drop in the farm gate prices, the farmers still should be happy and they should be content. But the main point is productivity and reducing the cost of the farm level. So that is the part which, of course, currently which is challenged because of the disease and other weather climatic condition issues. So we should see how the farmers will move ahead with that.
Right, sir. Understood. Thank you for all your elaborate answers, sir. I'll get back in the queue for any follow-ups. Thank you, Mr.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Hi, thanks for the opportunity. My first question is if you can comment on the normalization in the U.S. market, i.e., what is the best guess as to when the markets will normalize or you get back to your normal level of business in that moment?
Yeah, the U.S. market, of course, as I said earlier, the U.S. market, of course, we are expecting normalcy as the cases reduce and as the Center for Disease, the CDC guidelines in the United States, they relax the norms based on the reduction in the COVID-19 cases. And as the deaths reduce, they are also going to relax. Right now, it has slowly been moving. They are opening up restaurants. They have also given permission to open up movie theaters. So it's slowly opening up, but they are running at a limited capacity. Currently, it is around 25% only. So as they give more relaxation and give permission for higher capacity of occupancy in all these places, primarily the restaurant chains and all these public gathering areas where the food is primarily consumed in this market, in the U.S. market, we believe things will be much better. However, we do have a sweet spot in the current financial year is, even though it's not totally substantiating the loss of food service or restaurant chain business, which I have mentioned earlier also, the retail did give some hopes of better, there was a good stable and steady business growth which was there in the retail segment. So I think we will eventually develop, and as the occupancy rates level that these restaurant chains and food service outlets increase, we strongly believe that the consumption of proteins and food, protein and shrimp in general would be going up. So we are confident that as things come out of COVID-19 situation, because markets like USA and European Union are not so fortunate enough like markets like China or India, where COVID-19 doesn't seem to have much of an effect as such, whatever reason it is, whether it is herd immunity or whatever it is. So anyway, vaccines are doing its part, so things are getting better. As the cases come down, they will also be relaxing the norms. Yeah.
Okay. My second question is, what percentage of our revenue is from the retail now?
Sorry, can you repeat that second question? Sorry.
Yeah. What percentage of our revenue is coming from ready to eat, or the retail segment that you just referenced?
The ready to eat is not entirely retail, but currently we just don't have any ready to eat. It's 22% in the Q3 revenue.
22% is ready to eat.
Ready to eat, yes.
Okay. And why is retail not the same proportion? What's the delta between the two?
No. What I was trying to tell you is the ready to eat doesn't get absorbed entirely in the retail, but it doesn't mean that ready to eat alone is going to the retail. Please understand. Ready to cook also goes to the retail. So in the current context, if you ask me, we would, our company specifically, with regard to retail, we would say almost 75% of our business in the United States and almost an equal percentage of business in the European Union, almost 70 to 75%, is in retail segment only. There is a marginal of 25, max 30%, very high side currently, which is in the food service. So with whatever business has happened so far. So in general, yes, we have a major percentage going into retail. And that was one of the a coincidental advantage which the company also had in the current troublesome year. So almost 70-75% is there on the retail, but that doesn't mean that entire retail business is ready to eat. Ready to eat, of course, it was 22% in Q3 and 11% in the entire 9 months, because the first quarter it was not. So as the quarters are going by, our ready to eat shipments subject to these logistical hassles, our ready to eat shipments are increasing as we go by each quarter.
Understood. And you are selling it under your own brand name in the US, the ready to eat, or is it white labeled by somebody else?
Sorry about that. I would need to clarify. The company's business, majority, almost 95%, is B2B only. It's not B2C, number one. Number two, we sell to the major retail and food service chains in their brand. They want it packed in their brand. So in one way, we don't regret that we are not packing in our own brand, but at the same time, we feel we have the pride that we are able to place our products in some of the largest retail outlets, whether it is in the United States or in European Union, for that matter.
Okay. Thank you. I'll come back in the queue.
Thank you. The next question is from the line of Dipesh from Equirus. Please go ahead.
Yeah, hi, sir. Thanks for taking my question. Sir, I just want to understand that despite the food service sector not operating at full capacity, the US shrimp imports have actually increased by 7% in calendar year 20. So, was this the actual demand, or they have built up the inventory which can hurt the demand in calendar year 21? What's your view on that, sir?
So the first thing, with regard to the demand in the US, even though the food service has not been doing well, I did tell you that the retail segment has done fairly well, but it is not in a position to substitute the entire loss of food service, number one. Number two, when you are noticing the increase of shrimp imports from other countries, say countries like Ecuador, for example, especially, you are also seeing a drop in the exports of India to the United States. That also has to be looked into. Overall, this year, yes, there are also inventories have also been there, but there are also products which are missing their schedules and not making it to the market in time. But overall, we believe this year, if you see the entire calendar 2020, it's not been the same as 2019 for sure because of the pandemic effect. So we believe things will be much better in calendar year 2021. So there were some changes in supplying nations. I mean, India has dropped down, Ecuador has increased, Vietnam has also increased. Like different other countries have got the advantage, unfortunately, because of the situations in India, whether it is ones of headaches during the lockdown period or subsequently whatever new troubles which have brewed up. So, and also supply-related issues. But there has been change in supplying nations, but overall, the U.S. imports have been lesser than last year.
Okay, no, so the data actually shows, so maybe we'll check that again, but data actually shows a growth of 7%, so that's why I was wondering whether they have built up the inventory level which can hurt the demand in CY21 also. But Fair enough. Secondly, my question is basically that the MES incentive was like totally reduced to almost zero level in like last quarter, but the farm gate prices have not dropped, right? So are the processing companies taking this hit, or do you think we can pass it on to the farmers if the new rates are not aligned with the older rates?
The farm gate prices being very firm was primarily due to, of course, the lack of supply, and of course, it was an indirect hit on the companies to a certain extent. But as I had elaborated to one of the earlier callers, that is there every year. It happens every year where there is a mismatch between the supply and the demand which is there from overseas, or the prices at which the overseas customers are able to buy. Whereas because of the lack of supply or short supply, the companies in India at the source point do pay a little bit higher to fulfill their contracts. It happens every year. This year, of course, it has been there for a little longer duration. And as we speak currently, the correction is also happening at the farm gate prices. It is imminent. It's not going to sustain for long because there is no clarity on the government of India provided incentives and these logistics issues which are there, which are not making it feasible for any of the export companies to make shipments. So, and they're going at a very reduced level. So the correction was bound to happen, and it's actually happened, and it's happening as we speak. So yes, marginally there was a company definitely have taken a hit to a certain extent for sure.
So lastly, sir, if you can just give break up the export incentive into MEIS and the duty drawback in the third quarter, and also are you booking any incentive in the fourth quarter, or you're waiting for the government to give the rate?
The export incentive net did not have any MEIS at all. It was entirely duty drawback. So the net benefit of 1.63 crore, which, sorry?
Why was that, sir? Because 2 crore was the limit, right? So you could have done that.
No, 2 crores was taken off in August itself.
Okay, you booked the entire thing in last quarter. Okay.
Yeah. It was gone in that. It's actually September.
Yeah.
So you don't have any MEIS at all from October, November, December. Nothing. For the third quarter, there was no MEIS. Whatever you are noticing there is drawback only, number one. And the new scheme, we are not booked anything as we don't have a clarity of on the government policy or the decision. So we are still awaiting. We just heard that hopefully they're going to announce it soon, because right now it's between different ministerial discussions, and very soon they're going to announce. We understand that the committee has already recommended. We don't know what they have recommended at this point.
Okay. The hatchery sales number, can you give in the third quarter, please? Hatchery sales, what was that?
The hatchery sales, 1 minute, please. Vijay Kumar, hatchery sales.
Hello.
Yes, sir.
Yeah. Hatchery sales 2 crores 45 lakhs.
Okay. Thank you, sir. Thank you, and all the best.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Yeah, thank you for taking my question. Sir, can you give me the third quarter export revenue?
Sorry?
Third quarter export revenue.
Yeah, it is third quarter export revenue. Around 154 crores. In that, it's 153. Sorry, 153 crores. 43.
Sorry, 153 or how much?
153 crore. It's 154 in that. Of course, seed sales was there, 1 crore. And then, sorry, exactly check on it. It is not there. Export
150 crores. 150 crores.
Okay.
150. 149.99. 150.
Okay. Sir, next on the realization, because I can observe their realization as of yours, as well as for India, for the entire year, this CY20, looks better than the YOY perspective. Even though if I look at India definitely has loosed somewhere on the the US export side. 3 other countries has actually managed to grow quite significantly. So what the problem? That's only the logistical issue was the problem, and that's resulted degrowth for an India as a whole, or something else to look at it, because the other countries has gained significantly, like Ecuador, Indonesia, or Vietnam. What's your view on that?
Well, firstly, with regard to the third quarter, of course, and as we also go into the fourth quarter, we do have logistical challenges largely impacting the revenue for sure for everybody in the country, in India. With regard to Ecuador, one of the ease and convenience which that country has is their increase in exports to the United States was at the cost of their exports to China, because of China blockading their imports from Ecuador. A lot of Ecuador shipments have been diverted to the United States. One of the major reasons why their exports to US have grown significantly. Whereas the other convenience which, of course, most of the United States importers would also see is when they import from Ecuador, they get their finished product within a week's time. Whereas while they import it from Asia, it could take anywhere from 3 to 5 weeks, depending on from where they are purchasing and where it needs to go to. So that way, Ecuador has diverted its shipments which were being lost to from China, as China had restrictions on them, and so they're diverted. But overall, for us, from the third quarter, we do have issues with regard to logistics. Of course, there were some supply-related issues in general, but logistics is the primary reason why our revenue has been down. And even though we could source the product, and we do have higher inventories because of our sourcing being at much lesser level compared to the previous quarter. So we couldn't really do the logistics. We couldn't really overcome the logistical challenges, thereby affecting our revenue, unfortunately.
So what your sense is like, because we have somebody has replaced where as a India or as a EU supplied to. So is it going to be difficult to gain back those businesses, or we have some USP or some upper hand, we will get it very easily?
First and foremost thing, India has an established reputation across the globe because of the quality of the product which is there as such. So like we are all having temporary changes in our lives because of the pandemic. Naturally, we have temporary problems, issues, and they are meant to be temporary, like the pandemic.
Okay.
So definitely, this is all just a matter of time. India still has its advantage with, of course, for the major period being one of the competitive and aggressive supplying nation. Definitely, India will overcome all this, and our company as well as the entire sector in India will get back on its feet as things change. And as I said, we are definitely good. These are all temporary hiccups which will be there whenever you have a temporary setback like a pandemic, which we have. The last time we had the pandemic was 100 years ago. So we definitely hope that we don't get it for another 100 years. So, yeah.
Yeah, and on the realization front, sir, because that's form up very well. So is that our ready-to-eat mix has been improved, and that's why the realization were good?
Yes, definitely ready-to-eat helps us. Even in an appreciating rupee scenario, definitely ready-to-eat helps us, and we are confident that it will be helping us further going over even in the next few years as we do more of these ready-to-eat products. Definitely, that is where
we have, but capacity for ready-to-eat is around 21% of our entire. So are we going to switch to ready-to-eat more, because our sales contribution already is 22%?
The thing is, the currently we have plan. We had a plan. It's still there, where we are expanding our ready-to-eat capacity also from 5,000 to 10,000. But it has not yet been formalized because of the recent issues with all the problems, challenges which we are facing with regard to logistics. Logistics did not affect only our exports. They are also affecting our inputs. Certain food additives and ingredients which we are supposed to be utilizing in our process flow are also affected because of these container shortages in European Union primarily, and also the United States, where our inputs are stuck or they are taking more time to come to us. So similar way, equipment and all of that is being planned. We do have a plan to enhance our ready-to-eat capacity, and definitely future whatever capacity expansion happens with regard to our company in the processing segment will happen only in ready-to-eat.
Okay. Yeah. Sir, how was the farm gate prices last quarter, 3Q? Can you give the number?
Sir, Vijay Kumar Shiktar have last quarter raw material.
Farm gate price, 306 rupees.
Sorry, say again, sir.
Hello, quantity. Hello.
Hello, yes, sir.
Yeah. Farm gate price 306 rupees last quarter.
And our raw material cost?
No, that was our raw material cost. When he's giving you 306 rupees, that is our raw material cost for last quarter. When you compare it to the previous year, again, remember our raw material cost is based on an average of sizes which we purchase, which we source from the primary producer. So it keeps changing. It is dependent on the percentage of larger sizes, percentage of smaller sizes which we buy. So for the last quarter, it was 331 rupees. Sorry, I don't know where it's made a mistake. 331. 306 rupees was Q3 FY20. Q3 FY21 was 331 was the Q3's raw material cost for us.
Okay. Thank you, sir. Thank you for taking my question.
Thank you.
Thank you. We would request our participants to please limit your question to 2 at a time. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, my questions have been answered. Thank you.
Thank you. The next question is from the line of Ritesh Bhagat from BBO Advisors. Please go ahead.
Thank you for the opportunity. So I just have a general question.
Mr. Bhagat, your audio is not very clear. May I request you to please check?
Am I audible now?
You are audible at the moment. If you are on speaker, please come on the handset mode. It will
I'm
be
on
clearer.
the handset. Thank you.
Thank you.
Okay, so just I have a general question as such. Given the demand-supply scenario and the export incentives, which we don't have much clarity on, do you see the EBITDA margin sustain over 2 to 3 years period in that ballpark range of 12 to 30%?
Yeah, for that question, I do hope that the government of India will not take that much time to give it clarity on the export benefits which they plan to give to the sector as such. For sure, hopefully, it should be resolved soon. That is number one. Because when you are asking me for 2 to 3 years, when you're asking for 2 to 3 years, definitely we're going to get a clarity much sooner than that, and that will accordingly shape the way the farm gate prices will eventually be, in the direction in which they move, and at what levels they need to be stabilizing. Because the export prices are not going to be India specific; they are global specific. So whether it is India, Thailand, Vietnam, it's all a global market, and so naturally it is the global demand supply scenario overall will be affecting the export prices. Whereas the farm gate prices, definitely one of the major factors is also the export benefits which are there. So overall, even if the export benefits are, hopefully we are hoping that they maintain, even if they reduce. We have been emphasizing on this point almost for more than a year, that we would want to increase and improve our value-added product capacity, and that is the only approach which is going to make our company sustain its margins in the longer term. So definitely, and we are moving in that direction. We will eventually be going in that direction, except that this scenario of the last quarter where the expenses, of course, have been significantly up, the fixed expenses, and primarily because of the revenue drop by almost 20%, which had affected. Otherwise, we are confident that as we come to normalcy and as we do more of these ready-to-eat products, definitely we'll be able to do it in a good manner with regard to retaining our margins for sure.
Okay, thank you. Just a follow-up question. I think the current capacity in ready-to-eat is 5,000 metric tons, right? And we're planning to increase that by a similar amount, if I'm not wrong, if I'm not mistaken. Is that correct?
We said we were planning to increase that to double it, basically. So from 5 to 10,000. So it should be happening sometime within 12 months. We actually planned to make it happen in 6 to 8 months, but we are just planning it up. We'll be making the decisions of that before the end of this financial year, and we'll be closing the work orders for that.
And any additional capex you would require to set this up?
It is not significant. It will be approximately around 6 to 7 crores max, not more than that. It will be on a higher side. Yeah.
Thank you. Thank you for the response. Thank you.
Thank you. The next question is from the line of Vishwanath Singh, an individual investor. Please go ahead.
Yeah, hi everyone. Good morning. My question is, do we expect significant increase in debt because of the COVID-related stress in the aquaculture sector?
I'm sorry, can you repeat your question? You said, do we expect
significant increase in debt because of the COVID-related stress in the aquaculture sector?
Well, we do expect working capital cycle to be stretched because of the COVID issues. But we also need to make a note that these COVID issues are getting resolved and coming back to normalcy. The sooner they come back, for sure the working capital cycles will come back to normalcy. And of course, the requirement of such a debt also could be limited and reduced as we go into the normal conditions. So it is only because of these temporary setbacks which have come, the COVID-related effects, whatever the stretching of working capital cycle has increased. That is the effect of that. And as I mentioned earlier to another caller, temporary setbacks do have temporary repercussions. They will accordingly be resolved as normalcy comes into the business.
Okay. But we are still able to manage the debt, right? I just wanted to understand, because of this pandemic-related stress, let's say even if we assume that it goes on...
Yeah, naturally, if you see the logistics issues attributing to, for example, higher inventory or our receivables being delayed by additionally 15-20 days or sometimes 25 days because of longer sailing times, which I have explained to one of the earlier callers, this would definitely have an increase in realization periods as well as to support the business. Naturally, there will be an increase in debt to that effect. And as things come back to normalcy, naturally, our working capital cycles also get reduced. Thereby, the need for such higher debt also gets diminished.